Hello everyone, a very good evening. Welcome to Oliveboard. This is the unit 6 of module A of our BRBL paper for the CAIIB Foundation July 2025. We have already completed the first 5 units from module A, and today we are going to start with the unit 6, which is non-banking financial companies or NBFCs. And all the other units, the videos are already available on the YouTube channel. If you haven't yet seen them, please make sure that you watch them because they are very important. They are a summarized form of all the units, so they're very important from the exam point of view. And also don't forget to subscribe to the channel so that you do not miss any of the updates. Now let us start with today's chapter, which is the non-banking financial companies. So NBFCs, we already know, play a very important role in the rural credit and credit mobilization, right? The various activities with the NBFCs, they're allowed to engage in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, or activities they cannot, the activities that they cannot transact, right? So now let us start. Let us start with the first point. Okay, so if we see the registration of NBFCs, so NBFCs is a company, a non-banking financial company is a company registered under the Companies Act of 1956 or 2013. And like I just told you, the various activities engaged in the business of loans and advances, acquisition of shares, stocks, or issues, the securities which are issued by the government or local authority, or other marketable securities, right? But it will not include the institution where the principal business is that of an agricultural activity or industrial activity, but direct purchase or sale of goods other than securities, or for the sale, purchase, construction of immovable property. So only in the banking business, this NBFC is involved and registered under the Companies Act, right? Next, if we talk about the supervision, so the Department of Non-Banking Supervision of RBI. This department, DNBS, is under RBI. It is entrusted with the responsibility of regulation and supervision of NBFCs under the chapter 3B and C and chapter 5 of the RBI Act of 1934. So this is an important point, under whose regulation or under whose supervision the NBFCs work. So it is a department created under the RBI. So indirectly, RBI has the power of regulation and supervision of NBFCs under which chapters 3B and C and chapter 5. Now, another important thing is that in terms of section 45, 1A of the RBI Act, it is mandatory that every NBFC should be registered with RBI. Before the NBFC, they want to carry on any business of the non-banking financial institution, first they need to get registered with RBI. So RBI is going to see the various norms and guidelines, whether they are working according to that, do they have the minimum paid up capital or other requirements, and then RBI is going to grant the license of NBFC. All right. Then if we talk about the various activities of or role of NBFC, so NBFC has a very important role in promoting the inclusive growth, right? Then it gives out credit to the MSMEs, the microfinance institutions. They give access to basic financial services like loans, savings, money transfer, monetization of gold, like gold loans are also provided against gold jewelry. Although banks also provide that, but NBFCs, they have shown better or phenomenal growth, we will say, as compared to the bank because of their simplified sanction process, quick loan disbursement. It also provides second-hand vehicle financing, affordable housing. So it helps in many ways for financial inclusion, for helping the weaker section of the society. And we have already seen the registration of the RBI, of the NBFCs under RBI. Now there's an amendment that was made, dated September 1, 2016, which issued the regulatory guidelines in respect of NBFCs. This is the NBFC systematically important non-deposit taking company and deposit taking company. So the ND and D, these are two categories of NBFCs, the non-deposit taking NBFC and the deposit taking NBFCs. For all of these categories, certain new guidelines have been issued in 2016, right? So these are applicable. Then the NBFC factor, which are registered with RBI, the infrastructure debt fund, the microfinance institutions, the infrastructure finance companies. These guidelines are applicable on all of these entities. So the guidelines are regarding the requirement of net owned funds and the capital requirements. If we talk about the net owned funds, so the Reserve Bank has specified 200 lakh rupees or rupees 2 crores as the net owned fund which is required for a non-banking financial company for carrying on or commencing on the business of non-banking financial institution. So this is the requirement, rupees 2 crore. So the net owned fund of the NBFC should be how much? Rupees 2 crore. Then if we talk about the capital requirements which are given under the guidelines, first, every applicable NBFC, whether it is a non-deposit, deposit taking, infrastructure debt fund, factor, or it is any other, right? They need to maintain a minimum capital ratio consisting of tier 1 and tier 2 capital, which shall not be less than 15% of its aggregate risk weighted assets on the balance sheet and off risk adjusted value of balance sheet items. So 15%. 15%. Then if we talk about the tier 1 capital in respect of the NBFCs other than the microfinance institutions or the infrastructure finance company, what is required of them? At any point they shall, the capital requirement shall not be less than 10%. All right, it shall not be less than 10%. Finally, for the applicable NBFCs which are primarily engaged in lending against gold jewelry. So if their primary business is giving out loans against gold jewelry, then they shall maintain a tier 1 capital of 12%. So three amendments or three guidelines have been given for the capital requirements. Every applicable NBFCs, every applicable NBFCs, they have to maintain 15%. Then other than MFI and the IDF infrastructure debt fund, 10% for tier 1 capital, and for the NBFCs which are engaged in the loans against gold jewelry as their primary business, they shall maintain the capital requirement of 12%. So these are the capital requirements. Then one very important topic, in fact the most important topic of this chapter, there's a revised scale-based regulatory structure. Now the NBFCs have been divided into four layers, which is based on their size, their activity, and their perceived riskiness. Right? So there are four layers. We have the base layer, which is at the bottom, then the middle layer, the upper layer, and the top layer. All right, this is the revised scale base. So if you're asked what is the basis for this classification, the NBFCs, they are divided on the basis of their size, activity, and their perceived riskiness or risk taking. So first we have the base layer. The base layer would comprise of the non-deposit taking NBFCs below the asset size of rupees 1000 crore. So the NBFC non-deposit ND that have the asset size of below rupees 1000 crore, they will be included in the base layer. Then the NBFCs which are undertaking the following activities like peer-to-peer lending platform, account aggregator, non-operative financial holding company, and those NBFCs which are not availing public funds and are not having any customer interface. So first we see the size, which is less, below the asset size of 1000 crore. Then we see these activities, and also having no customer interface, not availing public funds. So the most less risky business, we'll say. So these are included in the base layer. Then the second layer is the middle layer, which would consist of all the deposit taking NBFCs irrespective of the asset size. The all the NBFCs, deposit taking NBFCs, will be included in the middle layer. Then those non-deposit taking NBFCs with the asset size of rupees 1000 crore and above, less than 1000 crore, are included in the base layer. More than 1000 crore are included in the middle layer. Then, according to the activities, the standalone primary dealers, the IDF, infrastructure debt fund, core investment companies, the housing finance companies, and the infrastructure finance companies. All of these entities are included in the middle layer. So we need to remember that all the deposit taking NBFCs plus the non-deposit taking NBFCs which have the asset size of more than rupees 1000 crore. Apart from that, if they are undertaking any of these activities, whether they are the primary dealers or the infrastructure debt fund, housing finance companies, all of them will come under the middle layer, right? Then the third layer is upper layer, which would comprise of those NBFCs which are specifically identified by the RBI that require enhanced regulatory requirement based on a set of parameters and scoring methodology as devised by them. So here we will say that they have a higher asset class, or they have higher risk taking riskiness. So RBI has put them into the upper layer. So only the top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer, irrespective of any other factor. So the top 10, the highest asset size NBFCs, will be kept in the upper layer. Does not matter whether they are the activity in which they are engaged in, whether they are housing finance companies or standalone. If their asset class is in the top 10, then they will be included in the upper layer. And finally, we have the top layer which ideally would remain empty and may be populated if RBI is of the opinion that there is a substantial increase in the potential systematic risk from the specific NBFC. So those NBFCs, the top 10 NBFCs which were kept in the upper layer, because they require enhanced regulatory supervision or enhanced regulatory requirement is there, a set of parameters and scoring methodology is being followed. If among those 10 NBFCs, RBI feels that there is even higher level of supervision required, there is increased potential systematic risk, then they will shift, RBI will shift these NBFCs from the upper layer to the top layer. Otherwise, this top layer would ideally remain empty, right? So such NBFC shall move to the top layer from the upper layer. All right, so these are the four layers, these are the four categories of NBFCs. Then one very important topic from this chapter is the co-lending model, the co-lending model. So co-lending model means an agreement which the banks and the NBFCs they enter into, and they post the policies on their website that together the facilities provided by the bank and the facilities provided by the NBFCs. So for this, the banks and the NBFCs shall formulate a board approved policy for entering into the co-lending model, right? So they can be entered between the two partner institutions. It will include the terms and conditions of the arrangement, the criteria for selection of the partner institutions, the specific product lines and the areas of operation, along with the provisions related to the responsibilities, customer interface, and protection issues. All right, so mandatorily the things, the conditions that will be followed by the banks and that will be followed by the NBFCs will be put in place and it will be approved by the board. All right. So a board approved policy for entering into the co-lending model, wherein everything, all the terms and conditions that will be fulfilled by the two partner institutions will be mentioned. All right. Then other topics from this chapter, like what is the bank finance to the residuary NBFCs, or which is also known as the RNBCs, the activities which are not eligible for bank credit, the activities which are undertaken by NBFCs but are not eligible for bank credit, like the bill discounting or rediscounting, investments in the current or long term nature, unsecured loans, all the loans given to subsidiaries, group companies. These are such topics which we will cover in other chapters as well, right? Then, if we talk about the corporate governance, so all the applicable NBFC base layer, they need to have a risk management committee, right? They are going to focus on risk management. Disclosures are need to be made. They are need to be expanded to include the different types of exposure, like related party transactions, the loans to directors. Then, if NBFCs are giving out loans to directors, senior officers, and relatives of the directors, right? For that, where the board approved policy is required as to what should be the quantum, what should be the terms, what should be the regulations. Then, we also need a key managerial personnel, a timeline as to which this managerial person will not hold any other office in any other NBFC in the middle layer or the upper layer. All of these things are there. All right. Then there are certain prudential guidelines which are applicable, like the existing limit of loans, investment which is allowed, what is the revised limit or loans, the ceilings of the investment, and the infrastructure finance companies, right? So these are the various topics in this particular chapter that you will come across when you study this. So more detailed discussion, more detailed revision is required, but for a summarized version, these are the important topics, and from the exam point of view, the categorization is the most important as to which types of NBFCs, which categories of NBFCs will be included in which layer among the four layers that have been given. All right. So that is all for today. We have summarized this chapter of NBFC. If you want to learn this chapter in detail, then you can take the course, the details of which are mentioned in the description. You can read about it, and the PDF can also be downloaded. The link will be available soon. If you have any doubt, any query, you can let me know. And we will then meet again tomorrow at 8 p.m. with another chapter, with the next chapter. And with that, we will finish the module A of our syllabus and we will move on to module B. Module B, which is more important from the exam point of view. So till then, keep revising. Make sure that you download the PDF and you revise the topics. And if you come across any doubts, then let me know in the comment section. Thank you so much for attending.